Hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management in Palm Desert, California. I have a special guest today. It's our Election 2.0 edition. We are so privileged to have our very own Hightower's Chief Investment Strategist, Stephanie Link. Stephanie, thank you for joining us today.
Thank you for the invitation. It's great to see you.
Now, Stephanie, where are you located? Where's home for you right now?
Home for me is New Jersey, and we had terrible weather all week long, but the skies just opened up, beautiful. So it's not exactly your kind of weather, but we'll take it.
Not yet. We're getting there. We got 110 right now, but we're slowly but surely. We could see a light at the end of the tunnel. So our mornings and evenings here in Palm Desert, California, are getting beautiful. So midday, we'll wait for it, but I think we've been through the summer, so we survived.
That's great. That's wonderful. Well, we're 60s and we're getting dark at 5:30.
Oh yeah, there you go. It's the change is happening.
Yeah.
Well, Stephanie, thanks again for joining us, and more importantly, welcome to the Hightower family. For our audience today, we have a lot of clients tuning in. A lot of clients will get this replay. Stephanie's new to Hightower, but not new to the investment management industry. In fact, many have actually reached out to us and said, "Wait a minute, I've seen Stephanie before." And the answer is yes, you have. Not only has she been, in the world of Nuveen and managing over $170 billion, co-managing and billions of dollars there, but you'll see her. I think you were just there yesterday on CNBC, a senior contributor from the Closing Bell, Halftime Report, Squawk Box. You're very familiar with Jim Cramer. You also helped manage his charitable trust. Your resume is outstanding. And to have you join us here and all of our partners across the United States just made Hightower that much stronger. So we appreciate it and looking forward to your insights and guidance that you've been providing to us. But for our clients here today. So thanks for joining us, Stephanie.
Oh, it's my pleasure. It's really my pleasure. I truly believe in the independent wealth management space. After being in the business for so long, I know you were rattling all that off. That's a lot of years. I have a lot of gray hair after all that. But I will say that after all these years being on the sell side and then being on the buy side, on the institutional side, they've had their challenges. And this is the one area in the industry, in the investment industry, that's actually growing. I just got off the phone with our CEO who said, we want to grow, and whatever it is you need, obviously responsibly, but we want to grow and expand and increase our market share. And that's the beauty of Hightower, right? We have the size and the scale, and then you have the industry growth on top of that. So And then you have talented advisors like yourself, so that make it a lot easier for people like me to go out and promote the good word.
Well, this is a wonderful industry. What's wonderful about it is it changes not only overnight, but minute by minute. And that's what's so exciting. Every day, as I tell my kids, every day is something new. So we have the opportunity to stay on top of that for our clients, especially relates to what matters most to them, which is how we manage their portfolios and keep them out of harm's way and also, grow their portfolio in a conservative, but, opportunistic fashion, if you will. But we're no stranger to the news cycle. And, today, why don't we just go right into it? We were hoping that we would get the debate when we were teasing this for all of our clients, the September 29th debate, first presidential debate of 2020. And now here we are, September 30th, and we're doing this interview. And I don't know that we wanted the debate result that we saw, because that was kind of crazy. But what we did see as it relates to investments right away, there were some headlines that post that debate changed the futures. Futures actually sold off significantly for a bit overnight, and then they rebound. Obviously, we're having a positive, big upside day today. We could talk about that as we go through this. But what's your initial reaction, take-home point, what the markets care about, what they see, how we should think about what we saw last night, if you will?
Sure, and I love that we'll have a dialogue about this as well. So I was very disappointed. I think pretty much everybody was disappointed because we didn't get enough. We didn't get enough information. We didn't get enough of, okay, President Trump, how are you going to continue the next 4 years? What are your policies? What are your main focus areas? We know he's focusing on China. That we know. So that's a given. But what are some of the other things? And we didn't really get that. We got a little bit of bickering back and forth. On Biden, we got a few things that he talked about, but not enough. And so I think that's why you really have the same kind of dynamics in terms of who is expecting whom to win, right? So Biden has a 6 or 7 point lead in one poll, a 4 point lead in some of the key states, swing states. It didn't really change that much. but it was disappointing overall. I will just say this. I think that the short-term volatility is an opportunity for the long-term investor. Because if you look at in the 18 of 19 presidential elections, if you put a $10,000 investment made at the beginning of each year, you would have gained at the election year, you would have gained value 10 years thereafter. That's regardless of what party actually won. And so in 15 of those 10-year periods, a $10,000 investment would have doubled. Wow. So if you think about long-term, let's use these opportunities because, quite frankly, not a ton is going to change. Yes, on the margin, if you get a kind of a blue wave, right? And you get, Democrat wins the president place, and then you also get Democrats actually run the Congress. Certainly, that's going to change what President Trump and his administration has done in terms of regulation and higher taxes.
Right.
But in the end, in COVID world, can you really raise taxes? Can you really raise them immediately? So maybe, just maybe, if the market were to sell off on a blue wave, and that's only because people would say, oh yeah, we're going to get taxes, and what does that mean?
Right.
It means, obviously, for corporations that they become less competitive. For individuals, certain individuals, it's going to be more pressure on them. They're paying out more. But in the end, it really doesn't matter in the long term. And I think for an investor, if you do get a blue wave and you do get all the taxes he puts in place, that's about 8% hit to the S&P 500 earnings. And the wonderful thing about the S&P 500 companies is they've learned over the years how to cut costs and restructure. And if they see a tax bill going higher, they're going to restructure and they will offset it. And so that's why I think if the market kind of gets a little spooked, I think on that situation, I think it's a buying opportunity. I think if it's status quo and we have Trump win and a mixed Congress, that's okay too. And I think that market actually might rally, although we could talk about sectors and who wins and who doesn't win, but that actually is a known, and the market likes a known, right? So that's why I say, a Dem sweep is an unknown, a status quo is a known, and then what I think stocks and investors want to see from an investment point of view is would be a Biden win and then maybe a mixed Congress, because then you don't get that much change. You get some change, but you don't get that much change. So I think you have to keep it all into perspective. Disappointing for sure last night. Maybe the next one will be better.
Yeah, Stephanie, that's great insight. And as we normally do in times of uncertainty for our clients, is look at the history as a guide. And I like the way you just framed it up where, while it always an election year and every 4 years becomes contentious and stressful and uncertainty, what we really know is at the end of the day, don't bet against sort of the American ingenuity of what we have here and the preservation of our capitalistic society, because corporations, as you just point out, they figure out a way. In fact, we can turn the clock back for our clients here at Blanke Schein Wealth Management 4 years ago, and it was just the unknown. Yeah. Betting odds were on Hillary and all the Democrats, if you will. And ultimately, we position our clients' portfolios sector specific, where, again, we have an election edition. I don't know if you have this. I provided this for you, Stephanie, but all of our clients, we've got the election positioning white paper that we produced, about 24 pages of our sort of best thinking as to how we're thinking about and positioning our clients' portfolio of the what if scenario. So taking you back to 2016, if you will, and the positioning, there was the healthcare if Hillary won, and there was a few others if, infrastructure and a few others if Trump actually got in. But we also position on cybersecurity. And so we realized if you take a look at that period of time, there's always an opportunity somewhere. And so cybersecurity was a big hit. It was a big hit for our clients, and it still continues to be a wonderful theme that strategically and opportunistically we take advantage of, because it really doesn't matter who actually gets in from a policy standpoint, because there are subsectors of the economy that will do well regardless. Now, we can overweight, underweight, again, healthcare and a few other things that we see, depending upon how policy actually changes over time. And that's what we're going to be holding our breath for, if you will. But to your point, long-term perspective in today's market, clients have been going to been blessed with the daily updates, and clients have been so grateful or so blessed us with the sort of watching the daily updates. And they've been asking us the questions, why is the market going up? And if you go back to the playbook about late 90s, if you will, when Greenspan ultimately supported the market, we're don't bet against the Fed. Right now, we got trillions of dollars here in the US, but also the monetary policy around the world. The last tally, that's $90 trillion globally speaking. So it really, regardless, to your point, whoever gets in the White House, there's still that liquidity and that backstop of sort of, opportunity right there to help equities, real estate, and even precious metals, if you will. That's the playbook. So don't bet against the Fed. I think there's a lot of opportunities that we're seeing on a daily basis, but that's what's playing out. I mean, is that how you're seeing it as well?
100% in agreement. 100%. It's, we've been around long enough that you don't fight the Fed. And you don't fight the global central bankers, right? You do not. So, and then when you add on fiscal policy on top of that, it's just so powerful. So let me throw a number out at you. You might have seen this or heard me talk about this on TV because I love this stat. But if you add the fiscal and the monetary policies that the US has put together, you combine them, it's 44% of US GDP.
Holy moly.
Back in 2008, the last kind of crisis that we had, if you added up the two, it was 5%. So this is a huge deal. And I believe very strongly that you are going to get a fiscal package. Now, I would argue if Biden gets in, you probably get a larger package. If Trump gets in, you probably get a smaller package. But you're going to get a package. And here's the reason. We have a very uneven economy. I'm going to give you positives, but I got to give you some negatives first. We have 14 million people unemployed. We have 14 million people unemployed. You can't have that. You have small and medium businesses falling by the wayside. You have travel, leisure, hospitality industries, as I'm sure some of your clients know, unfortunately, that are not doing well, right? They're really suffering. That is what needs the support. That is what needs the attention. And also, obviously, individuals, right? For some unemployment benefits extension. And I think you're going to get it. It's all a matter of the size and the jostling of the positioning here in the short term. It's going to happen. And I really feel strongly about it. Now, on the positive side, some of these fiscal and monetary policies that we've been talking about have led to much better than expected results in certain pockets of the economy. Housing is booming.
Yeah, huge.
Housing is booming. A million SAR, seasonally adjusted annual rate of new homes came out last week, a 43% growth. A million SAR. That is the number we haven't seen.
That's incredible.
Right? We haven't seen it since 2006. So you also had single family housing starts and single family permits up double digits year over year in the most recent figures. Supply is 3.3 months versus 6.8 months back in April. And just to put that into perspective, 6 months on average is balanced. So you're at 3.3 months. So the market's getting tighter. That's why you're seeing pricing actually going higher for homes. But at the same time, you still have demand because you have very low interest rates. And you have people fleeing from the cities and going out to where you live and where I live and that sort of thing in suburbia. Manufacturing is another place. Industrial production up 4 consecutive months. There's all kinds of surveys, and I don't want to get wonky on your clients, but PMIs and new orders within manufacturing are all very, very strong. In fact, some of the series in manufacturing, they're back to expansion mode. So manufacturing and housing, real highlights. And then I'm going to throw something out at you that might not seem so obvious, is auto. So auto sales, they stopped production back in March and April. And naturally, then you only did a 7.7 million seasonally adjusted annual rate in units, 7.7. We're on track to do 15 million this month. So 7.7 million versus 15 million. So auto is actually coming back. Consumer, as you know, is very mixed. There are haves and have-nots. But if you listen to companies like Lennar and Herman Miller and RH, which used to be Restoration Hardware, Nike, Costco, you guys know these names. All of these companies are putting up tremendous numbers because if you have the product and you have the investments that you've been making over the last several years, guess what? The consumer's going to buy. And so perfect to your example on cybersecurity, guess what you need to protect these companies on digital and on e-commerce? You need cybersecurity. So these are why these themes are so much more important than the election results. So hang in. We're going to be choppy for a couple of weeks. If we get a fiscal bill in the next couple of weeks, I think the market takes off. And if we don't, stay patient. And you, as a phenomenal, experienced advisor, are going to help capitalize on that for your clients. You'll say, okay, where's the opportunity? And I truly believe that that's the case. And again, the liquidity, back to your initial point, it's here to stay for a while.
Great insight, Stephanie, on that. And you're 100% correct in terms of sort of this is that opportunity as advisors and that we've been waiting for. I mean, the uncertainty, there is this sort of have and have nots. I did a piece a while back talking about the, size matters. Those companies that are public corporations have access to capital. They have liquidity markets to stay open. And in the short term, this year, 2020 is about survival, right? So if you can survive, the market looks through earnings of 2022, 3, 4, and 5 and beyond, pulls forward, because ultimately through this pandemic, if you will, unfortunately, policymakers, for whatever reason, chose favorites, right? You could go to the big box retailers, but you can't get coronavirus there. But you can't go to the mom and pop shop because you can get coronavirus there. And ultimately here in our small town, I'm sure you're seeing in your small town, I did an update yesterday about well over 35 sort of restaurants that we all know and love, and mom and pop shops are closing up, never to return. So when we talk about and what markets care most about, and we saw this happen, the market futures turned around and markets actually turned around when they first opened, is when Treasury Secretary Steve Mnuchin this morning, gave, to your point, hope again of some sort of compromise of a 2.2 trillion, maybe what the Democrats want, somewhere in between. But the markets, as we're seeing, are fully sort of anticipating something. And you and I know, we all know, go in your local community, it needs it, but it means more strategic, more, sort of sector specific, if you will, assistance. So there's the have and have nots, the small businesses that are really in need, and those that are unemployment, they need that unemployment assistance. But that bridge, that stopgap that we saw, at least for the first 3-4 months, policymakers came together early on in the month of, from May to March, or March to May, if you will, to pass what they did was incredible. And as we talked about it with our clients, the M2 money supply was up 23% year over year, month over month. It was the most ever. So we knew people, consumers, right? And I think that's the playbook of the Fed as well as Congress. You give $1 to the U.S. consumer, and 2/3 of our economy is consumption. We're going to work our way back in, and that keeps it sort of going.
It's interesting that you say that about M2. I always cite that as well. What's also interesting is the consumer savings rate is up 23, is at 23%. So typical normal, 6-7%, right?
Yeah.
23%. So everyone is saying, okay, they got money from the government and then they spent it all. No, not actually the case. They're actually saving it and they're being responsible. And so that, to me, is very encouraging as well. We'll have to see, but that is a very big stat. And I think, what about consumer confidence? The numbers we got this week, they were off the charts. That's
incredible.
The fourth highest ever in history. The fourth highest number for consumer confidence in history. And we're in the middle of a pandemic. And to your point, which is perfectly said, is that the market is a discounting mechanism. And it's discounting not only is economy getting better and gradually getting out of things, and obviously it's not going to be straight in a line. We're not going to go straight up, and we're certainly not going to grow 30% every quarter like we will in the third quarter. But we are recovering, and the market is anticipating as we recover, profits recover. And as profits recover, people are saying the market's expensive. Well, these are what they call trough earnings. So if things get better, earnings actually can get better. And it's not as expensive, especially when you compare it to the interest rate environment, this very, very low, extremely low interest rate environment. So I think the place to find investments are what I said: housing, manufacturing, some auto, high quality, blue chip, but also dividend growers. Because I'm sure it's hard to find yield for your clients, right? And so you don't want to stretch and buy high yield. You don't need to do that. But if you find blue chip companies that are growing their dividends, and there's a lot of them that are doing that, I think that's the place where you want to be.
Yeah, we're seeing that. So the consumer, right? You just framed it up where, if you take us back to early 2020, we had one of the best, if not the best, U.S. economies that we've seen in quite some time. So we had a strong U.S. economy as a backdrop to the pandemic. Fast forward, you get both fiscal and monetary policy and stimulus and support, I refer that to, and as I communicate that to my clients, as mom and dad savings and loan, MNDS&L. Okay, so they came to the rescue. We could see another sort of round, but they're debating of who's mom, who's dad, and who actually needs it the most. That's sort of the round two of the CARES 2.0 Act, of whatever they want to call it. But we're going to get that. We're going to see that money's going to work its way back in the economy. And then we say, okay, well, let's look at the discount mechanism. And ultimately, is the economy still functioning? Well, we're seeing pockets like real estate and a few consumer confidence and obviously the savings rate. But then let's go back to corporate earnings. And yesterday I just saw this reported on CNBC of, we're starting the third quarter earnings season, because that's really what we in the investment management world pay attention to. And, 13 out of 14 companies that are reported a beat of expectations. So 13 out of the 14 beat on an average of 27% average on an upside beat, where the average is usually 3 to 4%. And that is just, to your point of trough earnings, this is that moment in time where if you wait to take advantage of opportunities, if you wait to, I'm sure you're seeing on your screen as well as I am every single day, opportunities. 3, 6, 12 months down the road, it's not going to be so easy, right? From a, let's look at dividend growth, let's look at dividend opportunities. And ultimately, if you go back to the Fed and what they're trying to do, their dual mandate of full employment, and we'll talk about that in a minute, as well as inflation, if you will, you're going to want something to grow out of this whole environment. So you're going to want income that can rise over time, dividend growth. We're seeing the refinancing of municipalities every single day. I've got a refi sheet of muni bonds that are being called that we have to replace, right? Because they're taking advantage of these low rates. Same with corporates in my book of business. And so when we replace that, that's lower income. So our clients need that income replacement. So that's what we're spending most of our days looking to create, that total portfolio return, spendable return for our clients, because ultimately it's the cash flow that matters, right?
Absolutely. The cash flow matters in a very, very big way. That's one of the very first things I look at in fundamentals when I'm looking at companies. It's free cash flow, and who's generating it and who's using it. They're investing it in their business, but they're also returning it to shareholders. And I think what's interesting as of late is we're starting to hear everybody suspended their buybacks, right? We knew that in March and April and May, because everyone had to, kind of shore up their balance sheets and their liquidity. And we are seeing now in the last couple of weeks, companies slowly starting to increase their buybacks or reinstate their buybacks. In fact, we got 2 companies yesterday. Lowe's has an $8 billion buyback program that they just reinstituted. And this little small company called HD Supply, it's a housing related play. It's a non-res construction play. And they actually announced a new buyback. I almost fell off my chair when I saw that, because they're a much smaller company. So they obviously feel confident. And here's another stat that I want to throw out here, out to you. And I'm sure you've been watching this as well. I look at the CEOs and what they're doing, not necessarily what they're saying. I have to listen to what they're saying, but I want to know what they're doing. Right. And so to the point on cash, in July and August, we saw M&A activity total $256 billion just in those 2 months alone. It started with Warren Buffett. It started with Warren Buffett buying Dominion's pipeline company. Then it was Uber and Postmates. Then it was Siemens buying Varian. And then we saw last week a whole ton of flurry of M&A. I don't know what's going to happen with TikTok. I don't even want to go down that path at this point, but there's all kinds of discussion happening. And what that suggests to me is that CEOs do feel a little bit more confident. They do see a little bit more visibility. Nothing is perfect. There's always stuff to worry about. And I actually will worry. The market it always climbs a wall of worry. I always worry when the market doesn't worry, because that means people are complacent, right? And you're a little more vulnerable. But the companies, the CEOs are acting, and that is a very good sign. In fact, in August alone, there were 9 deals over $5 billion. That's the most ever in history. So just again, putting it sort of into perspective on free cash flow and what companies are doing and how they're acting, that's always a tell to me. And I like seeing it.
That's huge. It's one of those on their dashboard of things that we have to pay attention to that really give us a real-time signal if there's sort of short-term, long-term sort of things to be concerned, trouble ahead. And to your point, it's the IPO market and the new deals and the M&A and the activity that we've seen this year is staggering. No one could have predicted it. You don't even have the investment bankers in their offices in Manhattan right? They're not meeting face to face. There's no deal making happening over cocktails or anything. It's straight up Zoom to Zoom. Let's get this deal done. And we are having a record year, which then translates into confidence. It translates into liquidity, the healthy financial conditions. You don't go to market unless you know you have sort of you're going to have a sort of an uptick on your IPO versus if you go flat, it's everyone's a loser and everyone's never going to get another opportunity again. So that's a huge sort of positive that we're seeing, and we're constantly paying attention to it every single day, every single month, which is crazy to see this playing out. But it's not unexplainable. It's definitely, from us in the investment management world, we're seeing it. So let's go to, in the short term concerns of volatility. And I reported on this to my clients in a daily update on my YouTube channel, which is we saw the yield curve, the VIX curve, which is a volatility index, sort of change shape in terms of pricing from the month of October to November. And that was interesting. And then it was confirmed last night from sort of the debate, which was when President Trump was asked, do you believe in a peaceful transfer? He's like, yeah, well, we'll wait and see, right? Which means that's where futures started selling off, which means, oh no. And that's where the volatility is now being priced, which is the 2 weeks post-election. Traditionally, we saw, the volatility in the month of October, which we're going to see, this later this month. Who knows if it plays out? But the pricing market of those contracts is now in November, and we kind of know why. In fact, we saw that play out last night with real-time market movement based upon what was said. So it could be interesting if you take back to 2000, Gore and President Bush, and the hanging chads in the Supreme Court. There was that period of time where markets did sell off 12%. And long term, that became an opportunity, but short term, it was, what to worry about in the short term. So the volatility index is sort of pricing in November, volatility, if you will. So it's interesting.
There's a very good chance that we don't know for a few weeks. I don't think it's a few months. I do think worst case scenario, it's a few weeks, but there's a lot of people that are already expecting it. There's a lot of chatter. There's a lot of things that have been that I've read in terms of research from the experts that we're talking about it. So at least we're talking about it, right? At least it won't be like, right, oh my goodness, we don't know who the president of the United States is going to be. And we don't know even if it isn't Trump, is he going to contest what? But I do find it interesting that more than 1 million Americans have already voted. That is I thought an interesting stat that I read yesterday. So it'll be interesting. Volatility, you have to embrace it. That's the way I've always kind of viewed volatility. You have to have somebody that you feel confident in that knows how to look at fundamentals and balance sheets. And again, as we just talked about, free cash flow. You have to have a diversified portfolio. And you have to, I think quality always wins out. I'll tell you that's the one, I learned a lot under Jim Cramer, but that's the one thing that he always used to say. I used to want to go for the number 3 or number 4 player. It was really cheap and beaten down and that kind of thing in the equity market. And he would say, why do you need to go there? It's too hard. Like you can make a real lot of money over time from these compounders, and compounders just meaning they can consistently deliver year in, year out and that kind of thing. He was dead right. And that's actually the way I transitioned my portfolio when I was over at Nuveen. I said, why do I have to go for, the ones that are a little more speculative? I can own a few for fun, but I think the majority of your portfolio should be high quality companies. And I would just add that I know I had mentioned before that, I like housing and manufacturing, auto, consumer. I also think, and so those are more like cyclical, economically sensitive stocks. And if you think the economy is going to improve, like we've been talking about, that's why you want to own some of them. But I also think there's room in a portfolio for secular growth technology companies, to your point again, on where you're trying to pick and choose in sectors where you want to be overweight or underweight. I mean, if you think about the total addressable market for Internet of Things, it is going to be $1 trillion total addressable market by the end of the decade. My point is that this is why you do want to own some of these secular growth names. Maybe they're overowned, maybe they're a little overextended at this point, but you want to stick with these. And these are the ones that you also want to put on your shopping list if you get a 10, 12% pullback because of the elections.
Good point. question, do you believe that the market is buying a potential second wave of the pandemic here in the United States?
Yeah, I mean, I think I think that was part of the volatility that we've seen in the last couple of weeks. I think you are starting to see an increase. Here's what I would say to that. I mean, yes, we're all worried that we're going to see a second wave. We're watching Europe because they kind of started to see a little bit of a second wave thing. But I don't think they're going to be able to shut the entire country down again. When you do that, you lose $25 billion a day. That is an enormous amount of money, and that it's almost impossible to come back from, which is why it's been so amazing that we've actually come back from a lot of the despair and all these terrible numbers. So I don't think 100% is priced in, but I will also say this. I do think we've made much, much more progress to vaccines and testing than we were back in March, so that if we do have to close parts of the country in a significant way, that it might not be for too long. And oh, by the way, we also know that masks work, right? So wear a mask, right? I mean, I've seen some really cute, creative masks. Find a cute, creative mask, and honestly, it does work. So, but I do not think it's 100% priced in, and I think that will lead to some volatility if we should see the numbers worsen.
Yeah, I can see that. I think what you're also sort of discussing or translating what the market sort of sees is that we're learning to live with the virus. You know, if we go through, I'm not an epidemiologist. I have had enough sort of that sort of medical information in the last 6 months to make all of us, you know, very, very dangerous. But one thing is true is that viruses just don't go away. I mean, for us to think that the virus is going to go away in 6 months and we have a vaccine in 12 and everything's good, the market is sort of at first was like, no, that's not how this works. That's why it's sold off. And viruses don't go away. I mean, there are viruses that even Dr. Fauci was working on 40 years ago, and he's still working on them today. So the fact that we have 18 months or 6 months and we're all going to be okay, this is a real serious thing. We have to do the proper responsible things to reopen the economy, like wear the mask and have those people that are sort of, you know, pre-existing and susceptible. So stay home, and we can all work together to make this happen respectfully. But I think the market sees on a go-forward basis, the shutting down to the extent that we did, that's not going to happen. And even more importantly, the pull-through of technology has just been absolutely significant. I heard this the other day, 5 years worth of digital adoption happened in just 8 weeks. So what the market was pricing that was going to take 5 years happened in a course of 8 weeks. I know I've got 4 kids at home that are studying online right now, and Zoom and Wi-Fi is a thing, right? That's, you know, my wife probably couldn't know how to log on, nor could I. And now we're doing this video conferencing, even including our clients, right? So necessity is the number one skill at the end of the day. So we can figure it out and adapt. And it's amazing to see how sort of resilient and adaptable the economy is. I think that's what the market is seeing, regardless of wave 2.0, God forbid. Let's take it back to the Federal Reserve, because you and I have had several conversations prior to today, talking about when you're managing money professionally, sometimes when things are super on sale, like we saw back in March, that's the easy point in time, because you can just step in. We liken it like we're running into a burning building when everyone wants, you know, sky's falling, no one wants to touch it. And you're like, no, that's a high quality company, you know, number one in their category, best management team ever, selling at a 50% discount. We did here for Blanke Schein Wealth Management. I know you did too. We loaded the boat. And so clients are super happy with those names that we picked up with. Unfortunately, that's the easy part, right? It's when we sell going forward. And ultimately, let's talk about the Federal Reserve too. They lowered interest rates. So that was sort of the playbook, but when and how they start raising and changing interest rate policy, even the language, that's when it becomes tricky.
Very much so. It's not easy. I always have found it is easier to buy versus sell, and you do have to have sell discipline. But so on the one hand, I as I mentioned, a few themes. I want to make sure that those themes are still alive and well, and the fundamentals of the themes make sense. And if they do, I don't want to panic and sell just because a stock hit my target price, because we all know that stocks can actually overextend on the upside and overextend on the downside. If you look at the Fed funds futures,
Mm-hmm.
They're pricing a raise in rates 2023. 2023. And you mentioned it earlier, they're letting inflation run hotter than 2%. We haven't even been able to get 2% inflation in 10 years. So look, I do look at the inflation break-evens. I do look at copper prices. I do look at this massive 90 trillion number you cited before in terms of fiscal and monetary policies around the world. That should lead to some inflation, right? I mean, that's just what you would think. But then again, I just listened to what you just said about technology and the productivity and how customers are adapting and consumers are adapting. I feel like there is this push-pull on inflation. So you have to watch it. That's one of the things I watch. And you have to watch the growth rate of the economy and what it's doing. And those two factors, believe it or not, when inflation rises and growth rises, value starts to work over growth. So watch what sectors and what styles also work. And you have to be very mindful of that and how you are positioning in terms of sectors, overweighting certain, underweighting others, and that kind of thing. And that's why I go back to being balanced, being diversified. You're doing that for your clients, and I think that's amazing. And they're very, very fortunate to have your expertise and your perspective, right? And because you've been around a while, and that helps having that confidence in what your strategy is.
Well, thank you for those kind words on that. And I also want to continue to sort of talk about what the market sees for our audience, which is, you brought this point up, the labor markets. Labor markets are going to have a tough time, but if we go back in history, the last two times, 2001, 2002, and then 2008, 2009, each time was well over 5 years to get back to the peak employment that it once had prior to those two recessions. That's no different than this time, because small business owners, big and large, and big corporations are now doing layoffs as well. They're going to use and implement the technology, as well as the one worker is going to do the job of two in this type of economy. That's labor sort of disinflationary. So that's going to happen for a good long time. Again, markets see that corporate profits will be sort of reaping the benefits of that. That's why you want to sort of be long in the equity markets long term, because of that setup, if you will. It's no different. If you just watch history, it sort of give you that look through. And so that's interesting. It's very interesting. We're going to see the labor markets, unfortunately, going to be stressed for many years. Many years, because companies are going to use technology to use that as replacement. And I said this, and this is sort of the ugly little secret of recessions. Unfortunately, there's the older generation that is sort of the pre-retiree, and they're thinking about it. The company's thinking about it just as much, and ultimately, that's the highest wage earner for that corporation balance sheet. Well, they just got a free pass for no non-discriminatory sort of RIF, reduction in workforce. And that's happened every single time. And so you take that high labor cost off of a balance sheet, you bring in the younger labor costs, the cheaper labor costs, and ultimately these corporations are going to make tons and tons and tons of money. It happens every time. So when companies and clients ask, like, how can companies make money? Just pure basic economics, if you just follow what's happened most recent history, that is what's happening.
That's such a good point. And that goes back to what I said about if you get a blue wave, if you get Biden and a Democrat Congress, and you get the tax increases, although again, I'm a little wary that you can do that in a COVID world, but you're going to get some. In that scenario, if you look at what he's proposing, that 8% hit to corporate profits will be offset by what you just said. I mean, companies will continue to lay off and restructure and reorganize and take pricing where they can, right? Pricing power. And so that has what has been so interesting to me in this entire sell-off is that margins haven't fallen off a cliff, because we've seen all of this restructuring and all these fast moving policies put in place by companies to try to offset the weak demand. So I think that's why I say, if the market were to sell off, and I don't really know, but that's what some of the market pundits think, blue wave that we sell off. If you sell off, that is the opportunity, I think, from an investment point of view.
That's crazy. So it's so true. And if we look at even a blue wave, well, actually both sides, there's a good play there, which is the infrastructure play.
Oh yeah.
That's something that's either which way policymakers have to sort of address that, and both have signaled that there's bipartisan support for that. So that's, again, in our election white paper edition. If you want that, please reach out to any one of us on here at Blanke Schein Wealth Management, and we'll get you a copy of our report that basically talks about portfolio positioning that Stephanie and I just went through today. Stephanie, I think we've covered a lot of ground today. We're coming up on 45 minutes here. I really want to thank you for your time. If there's any departing comments for our clients, I appreciate this. We'd love to have you back. I'd love to have you, once again, sort of reach out to our clients again in this format. This is wonderful. And then again, when the time is right, some point in time in the future, and the weather's right, and you want to come out here in Palm Desert, California, we'll have you out for a private client event as well. And that would be a wonderful in-person welcome opportunity too. So if there's any departing comments, please, let us know.
I thank you for the invitation. This has been a lot of fun. I could talk markets all day long. So 45 minutes just went like this.
Yeah, so, it really did. I could do this too.
I know. And that's why it's fun. I'd love to do it. I'd love to do it again. And also, I will say this, we agree on a lot of things, but it's okay to disagree too. I have learned in my career that I have about 4 or 5 friends that I constantly email with about ideas and markets and what they're thinking. And sometimes we don't agree, and that's good. It's good to know the other side, because that builds your case, right? That builds your case. And if you know the fundamentals, but you're missing something, maybe they kind of help you. So I hope that your clients enjoyed the dialogue and the debate. Sometimes we're going to agree, sometimes we might not, but it's really always respectful. And I really appreciate it. And your clients are in good hands. That's all I can say.
You're so sweet. And Stephanie, thank you. We're longtime fans and listeners, and we'll catch you later this week, I'm sure, on CNBC as well. And again, once again, thank you and welcome to the Hightower family.
Thank you. Stay safe and be well.
Thank you.
Okay.
And
bye-bye.
Thank you guys for joining us. Tune in next time. Nyan's going to let us know if you want a replay you want to send to friends or family. Please let us know. And then also download our most recent election edition. Thank you for your time today, and we'll talk to you soon.